give it a start. And yeah, so hi everyone. This is Finance Meets Real Estate. We have Drew Kniffin here today. So he's the CEO of Nighthawk Equity. So Nighthawk Equity is the investment firm together with Michael Blank. If you guys have heard of Michael Blank, it's a a guy who does like a lot of YouTube and like great content, great value. At least I'm a big fan of him myself. So Drew runs Nighthawk Equity. What are your current assets under management, Drew, actually over there?
$275 million plus or minus, right around there. So it's full-time job, I'll put it that way. There's a lot of work there to do it well.
Right. Okay. So 175 million AUM. And in your previous, I just wanted to look at my notes. Sorry. So in your previous career, you worked as, so you have like kind of like a JD and MBA, right? And you worked as an investment banker, like in
corporate
operation. So that's a great background actually. We have like a few like finance people on this call, and so today you're going to talk about underwriting deals in today's high inflation market. So it's a really interesting topic for me at least. I'm going to pass it on to you. I'm just curious what you have to say about it, because it's become very, obviously it's become very interesting, and some of that might temper now, and you can comment like your views with regards to like the yield curve inversion and all that. But yeah, so I'm going to pass it on to you. And so if you guys have any questions, so we're doing like an open format, so feel free to speak up or put your questions on the chat.
Yeah, cool, Stefan. Thanks so much. I do love an open forum. So if anyone has questions on what I'm saying or what I'm failing to say, yeah, throw them in the chat, throw them in the Q&A, and we can talk about them. I just got a few notes to share here, and Stefan and I went back and forth with questions. So I'll share with you some thoughts on this current environment and what we're seeing, how we're underwriting deals, and what my crystal ball looks like. So I started this industry. It's kind of a slow sliding scale up, but I'd say 2013, 2014, I started spending the majority of my time thinking about analyzing, reviewing, overseeing multifamily assets. So I've been at it for 6, 7, 8 years, and they've been great years to own multifamily. They've been years where there's been a tremendous economic tailwind at our backs, and it's been too hard to look like a genius. Right now, there's people that still find a way to mess it up, but it's been a fairly favorable environment. And I would say it's been a fairly stable environment. When COVID basically took over the world 2 years ago, almost to the week right now, and we were preparing for the worst. We were stress testing every financial model, figuring out what expenses we could shut off entirely, and really going on defense. We were prepared for a tremendous pivot in the market. And for a lot of different reasons, that really didn't happen. We did see increased delinquency on tenants. We did see tenants who weren't able to pay as much, but the Fed kind of flooded the world with money. We saw the market continue to be strong. Those $45 billion of rent assistance, that wasn't the easiest money to get to, but it didn't fundamentally change the market. And so when I look at the market today, here we are, Q1 is in the bag for 2022. I see the market changing more meaningfully now than I ever have in the last just shy of a decade. And what we're seeing is, for the first time, a Federal Reserve that's changing its posture with regards to which half of its mandate it's trying to pursue. So the Federal Reserve has a dual mandate of full employment and price controls, or probably not price controls, but stable money. And we've been focused on full employment for a very long time, and stable money has been a given. And of course, it no longer is. We've seen, surprise, surprise, $6 trillion of fiat money creation occur in the last 2 years. And as a result, we're finally seeing prices go up quite considerably. So that starts off a whole cycle, right? It starts off a cycle of things, right? So prices go up. When prices go up, interest rates tend to go up. When interest rates tend to go up, there tends to be cap rates that go up. And so when you put all those together, there's a very open question. There's a very hot debate about what does that mean for underwriting deals today? What does that mean for investors? Is it too late to invest in multifamily? All these sorts of things. And I think that the syndicators, the people that are putting together deals today that are using the rules from yesterday are going to find themselves out of a job tomorrow, right? So I think we need to be underwriting and thinking about deals differently than we did before. And I was talking with kind of my mastermind about this on Monday, and some people were of the opinion that, you know, we don't want to sort of change everything too quickly. Let's kind of stay stable. But I think that's the wrong path to take. So I can dive into this more stuff, and I don't want to get too quant nerdy, although this is a kind of a quant group, I think. But I think we need to be thinking a lot about how we underwrite deals. Yeah, so I'll let some of the questions drive exactly what we talk about, but I think we need to think about underwriting deals differently from a couple different perspectives. Our assumed rent escalators need to be different. Our assumed cap rates on exits need to be different. And what was the last thing I was just thinking of? Our exit strategies need to be much more open to variations depending upon we need to have a broader timetable for when we can be exiting deals. So those are some of the things that we're working on. And then of course you still need to find deals that pencil, that make sense for the investor. Somewhere in the teens as far as a reasonably conservatively underwritten financial model. So those are things that we're working on. I'm happy to talk more about it, kind of go down the rabbit hole on any of those topics. But those are things that we're doing to underwrite deals differently nowadays.
Yeah, and that's actually that's like really great that you are going like that spot, especially I feel like after last week's news, right, with the yield curve as well. At least I'm kind of a little bit focusing on that. But just to stay on the first part, so before like all the like rent escalators, cap rates on exit, like other variations of exit strategies, right, that you mentioned. So before we get to that, what would be your perspective on like why what you mentioned in the first quarter of 2022, we are having a kind of more fundamentally different market, like, or different market conditions, and you mentioned the Fed there in comparison to even when COVID started. So like, what are some of the economic variables that you're tracking that you feel are, causing like the change in underwriting?
Yeah, I don't want to pretend to be someone I'm not as far as understanding a lot of the nuances of economics. But what I do remember is that inflation is basically a function of two things: how much money is out there and the velocity of money. So how fast are people changing money, right? So to your point, Stefan, this money was printed a long time ago. Now, sometimes it takes a while for the money to get pushed out, but it happened a long time ago. So why did it finally happen? Why did inflation start, kind of rearing its ugly head in Q1? Well, I think it's because essentially everyone got tired of being careful about COVID, or COVID got less severe. We kind of, Omicron happened and everyone's like, hey, this wasn't that big of a deal. And people said, let's go back to our normal lives. So you had all this money out there, but it was sort of kind of hiding underneath people's mattresses. And finally they took it out, they started spending it. And that is when the inflation started to take off.
What you mean, like, kind of, because we already had pretty high inflation in 2021, like in at least the last two quarters. And what you mean, like, worse in the Q1 of the current year, in the sense like just like further acceleration in this sense, or like what is your?
Well, I mean, Jerome Powell and the whole Fed kept on using the word transitory, right? For a long time, they were under this belief that this is just, don't worry, everything will go back to normal. Just don't look at the man behind the curtain, right? It's all fine. Just go on doing your thing. And then around Christmas time or January 1st, they dropped the word transitory. They were like, okay, we have a problem. The camel has gotten its nose underneath the tent. And now we got to switch our, monetary policy. So that's what I mean. I think that finally people began to believe, hey, this is not a passing thing. This is a substantive thing that should be priority number one in how we manage the economy on the front end, and then how we as investors behave on the back end.
Mm-hmm. And so we have inflation there. So that's like one big inflation, no longer transitory, call it, and like the respective monetary policy adjustments by the Fed, let's say. So that's like one element. Are you seeing anything else that is different in the market that prompts, more prudent underwriting?
Well, I mean, this is a little bit of a different answer to your question, but I think for those of us that are syndicators, the attitude of the investor has changed. So I think it was Keynes that said the investor is driven by two basic animal spirits, fear and greed, right? And so I think that pendulum has swung as inflation happened economically, but also, significant geopolitical instability since February 24th. There hasn't been a war on European soil in 80 years. Mm-hmm. And we have an unbelievable event happening over there. And for better or worse, wars get more attention. This war's gotten a lot more attention than other wars of a similar size have in the last decade. So you think about Syria, it didn't get that much attention. It was kind of similar. You think about Russia's invasion of Georgia, did not get that much attention, but this gained a lot of attention. And I think people are rewriting risk. And I know that the animal spirits of the typical investor, what they're talking about, the questions that they're asking are different today than they were 60 days ago. They're more concerned. Why does this deal make sense? How do you know? What about inflation? What if this happens? Are you sure that housing is still a good sector? These kind of questions weren't being asked before. Those things were assumed, and now they're being questioned, right? So the smart syndicator, the person that's putting together deals, that's trying to manage and grow the trust of their investors, needs to be presenting their deals differently. So the deal that we're going to be presenting on our webinar tomorrow, our presentation is different because the mindset of the investor is different. Mm-hmm. So I don't know how well I answered that question, Stefan, but those are some of my thoughts on how things are today. I see Nelson's got a question, but I'll let you lead there.
Really good. Yeah, go ahead, Nelson.
Yeah, and Stefan, as always, thank you for having these great guests on, Drew. I've got a question, and I'm gonna kick off with Kathy's first. Kind of going to the tactical and then more strategic. Can you talk about some of those rent escalation clauses that you were talking about?
Sure. Well, did I use the word rent escalation? I want to make sure I understand exactly what you're asking, Nelson.
I think that's, or some kind of rental clauses when
rent
you were talking.
You mentioned, Drew. I believe just like how much, like perhaps could be.
I think the question is, listen, hey, so I'll give you an example. We have a financial model that we've built in our organization called the Syndicated Deal Analyzer. And basically it's, if anyone knows Michael Blanc, the way that Michael and I became friends was, this is the very first thing he ever sold. It's basically a very fancy financial Excel model. And I was an investment banker back in the day. So I lived and eat financial models. And this was a really sophisticated one. So I started using it. We started becoming friends based on this. And in that model, the default rent escalator, to get to your question, Kathy and Nelson, is 2%. So if rent was $1,000 last year, it'll be $1,020 this year, and on and on and on. Mm-hmm. Now, the question is that a good assumption today? Should we keep on doing that, or should we do something differently? And I talked to some friends yesterday who basically said, steady as she goes, don't change your underwriting, which I think will, number one, you will miss out on doing deals, but number two, your model is a false model of the future of the world. It's not accurate, right? So we are underwriting deals differently. I don't think inflation or rent escalators will continue to be 10% every year for the next 5 years. If you put that into your model nowadays, Nelson, you'd probably think every deal is going to be a hero, right? You'd buy everything you could. You'd probably be wrong. But for the next 2 years, do we think that 2% is accurate, or is it more like 6 is accurate? What's a more accurate picture
Model.
of the future of the world. So we have, I think, to answer your question specifically, I think our model for the next 2 years is a 5, a 5, a 4, and then a 3.5. Right? So we've increased our rent escalators. Now, at the same time, we've increased our expense escalators. So we're not putting on happy years and only increasing rents and not expenses. Expenses are going to go up too. I mean, we've underwritten, as another example, Nelson, we used to underwrite, if you're going to buy a 100-unit property, we said payroll per unit per year is $1,200. So 120,000, right? So for a 100-unit property, you should expect that your payroll is $120,000. Well, that doesn't cut it anymore. I've had 2 people on our company, for good reasons, great people, ask for basically a 40% pay raise in the last couple months. And they've done it because someone else offered them that.
1 second. What kind of pay raise?
40.
40% pay raise?
40. Yeah. And my point is, we're seeing it on site too. So instead of underwriting deals at $1,200 per unit per year on payroll, we're doing it at $1,600 nowadays. So we've gone up 33% on our default assumption of how much we pay on-site staff.
So you're increasing inflation across the board, everything, just across the board.
Yeah. So yeah, I mean, that's right, Nelson. We are across the board on every line item of the P&L. We have assumed that inflation is increasing. Now, some ones we have a more unique opinion on than others, but by and large, I don't think you want to drive a car forward looking in the rear view mirror, and staying at 2% for me is doing that.
Okay. And when you're talking about, so as we're going on this story, right? Because all deals are a story. And then, excuse me, what are you looking when you're talking about your exit? So, and right quick, you mentioned like you were going to do 4% or 6%, and then 4%, and then 2%, right? On rent growth, on expenses. Why those timelines?
How long are the timelines?
No. Why those specific timelines?
Oh, well, first of all, I think as an anecdote, back when I used to be a banker, my managing director used to chew me out if I left 2 decimal points on any number. You know, the IRR is 15.12% projected on this deal. It gives you a false sense of precision. And these models that we have are they're like a compass, not a GPS. So they're not meant to give us an exact number. They're meant to give us a direction, a confident direction. So in that sense, the reason I say that is because I don't want to overthink it. I don't want to turn it into a science project and give people a false sense of precision that I know, down to the month when inflation is going to tick down. We don't. We know that generally the Federal Reserve gets inflation under control. They've done a pretty darn good job of it historically. It got away in the late 70s and the early 80s. But having said that, for the last 40 years, they've never let it get out of control. Here, they have a little bit. I'm confident that with time, they will get it back under control. That's why I wouldn't keep it at 7% forever. But I can't give you a precise. I mean, here's the other thing I'd say. I don't pretend to be the smartest person in the room, because the bond market is essentially the aggregation of all of the smartest people in the room. And the perception amongst the bond market is that the inflation will not stay elevated for a long time, right? And that's good enough for me to say, hey, for the next couple of years, next 2 years, I think we're gonna have some inflation, but overall, I think it'll get back under control.
Okay. And then as far as exit strategies, you were talking about different on the exit side.
Yeah, I think what I mean by that, some of our earlier deals, we were so captivated by the lowest interest rate possible that we locked ourselves into 10-year debt where there were significant prepayment penalties or yield maintenance penalties if you sold before then. And not only that, let's say that you loved that deal and you wanted to hold it for 10 years, but this has happened on our deals. You basically doubled or tripled investors' money in the first a couple of years, but it was impossible to strip that equity, turn it into cash, and put it back in investors' pockets and let them have that equity go to work for them again. It was essentially dead equity that was stuck in that asset.
Right.
And so for those reasons, we choose different debt products that have more flexibility in when you refinance or when you sell, and or your ability to extract equity and give it back to your investors. And I think in this environment, there could be some deals that you want to hold on to for a longer term. There could be some deals where you want to sort of take your chips off the table and have a quicker win, maybe a 2-year hold or a 3-year hold. And so I would much rather nowadays pay a little bit more in interest rates for the flexibility to exit than I did a couple of years ago.
Right. Thank you.
Yeah, you
Thank
bet.
you.
That makes sense. And we have another question on the chat. So what about the impact on landlords and owners from rental hikes, inflation, and income pay frequency for tenants? 40% of renters are on shortfall or behind the rent in the current economy.
I mean, in a sense, that's the entire conversation that we're having. Yes, there are tenants that are delinquent. There certainly are. But it's not as bad as we thought it was going to be at the beginning of COVID, right? When we underwrote, what if 30% of tenants can't make their payments? Here it says 40% of renters are on shortfall or behind the rent in the current economy.
Doesn't sound accurate.
I just that does not resonate with our portfolio, right? That's not what my experience has been. I can't speak to the the macro numbers or the national numbers. That's not where we're at. I mean, if a property had 15%, it's higher. I think 15% would be higher than any property we have. So, I mean, I'm happy to speak to that question more if you can kind of rephrase it or kind of narrow it. But I that's a little bit kind of more doom and gloom numbers than what I'm seeing across our portfolio.
Yeah, that makes sense. And I mean, at least what I've heard from other operators as well, it seems to be like much lower numbers at the current time. It's, to your point, even 15% is pretty high. But then do you think actually, like, one question quickly on that, like, in like recent news, like there's like the student debt kind of sort of that was, I would say, like people were led not to pay their student loan payments, for already like almost 2 years. So do you think that thing being waived potentially as of 1st of May, although it could be extended as well, that could affect like some of the rent, like some of the rent growth that we've been seeing so far? Articles on that.
Well, the rents weren't forgiven. They were just the sort of forbearance was extended, right? So
the student debt forbearance. So that's kind of the
right.
So those articles of student debt forbearance being waived as of 1st of May. That being the question in relation to, essentially a portion of renters being relatively young people who still have student debt, and so there's been like some dependency on that is being discussed, and like the considerations of like after 1st of May, like what would happen if with all the massive student debt out there, essentially, that some of the rent growth we've been seeing could have been like surplus funds that the younger population of people have who don't need to make their student loan payments.
I mean, yeah, I don't know how to sort of put all that together into an analysis other than most persons who have student loan debts are probably living, and I'm making an assumption here, but they're probably living in Class A or Class B assets. If you have $60,000 mortgage on your brain because you went to grad school, there's some properties that you're likely to live in. There's other properties you probably aren't going to live in. And so as an investor, as someone who's choosing properties, that might be something that you think about, right?
Yeah, that's a good point.
So I do know, I mean, you can spin this, you can think about this in two different ways. On the one hand, they haven't had to pay these payments in a while. So in the short term, they've had some extra free cash flow. That's what you're saying, Stefan.
Mhm.
The other thing you could say is I have a good friend from law school who to this day rents his home, and the mortgage on his brain, his student loan debts, are more than his apartment payment every month. And so for that reason, this friend of mine, super smart guy, he's now a corporate attorney at a Fortune 500 company, is a renter, right? So this is why the percentage of Americans that rent is increasing. I think it's now about 42% of Americans rent, whereas in the early zeros, it was about 35%. So it's going up, right? So you can make an argument that at the same time that there's a tailwind, there's also sort of a bullishness to that dynamic. And I don't know how it nets out.
Yeah. That's a good point. I agree. Yeah, that's actually very good. Very good consideration. Kati is asking, like, so you use a lot of tenants at 7% rent escalator, but maybe that's what you intend, to increase turnover so rents can increase even faster. Just not sure how tenants keep up. Yeah, basically the effect of kind of turnover and that.
I mean, so Kathy, I'd challenge your assumption, right? Like if the tide rises in a bay 10 feet, all boats go up 10 feet,
Yeah.
right? And if rent is going up 7% in every unit, across town or in your submarket, then the tenants are probably going to pay that because no one is a fan of camping for a lifestyle, right? Now, that can't go on forever, right? Like if rents go up at 7% forever, and the wages for your tenants go up at 2% forever, eventually rent takes up 100% of their rent. So it has to give at some point. Maybe Kathy, that's what you're saying. But in the short term, people are paying a higher percentage of their income to housing than they did a while back.
Yep. Nelson, go ahead.
Yeah, I'm gonna piggyback on the question Kathy asked, your answer. Your thoughts on things like rent control? Because I can see in certain places, and I grew up in New York on the time of rent control. And I mean, I had someone who I knew who was he was a cop in New York City. He lived in this beautiful place on Fifth Avenue. I remember I asked him how, he was getting over, bottom line, with that rent control. But do you see more rent control scenarios as we go forward?
Yes, Nelson, I do. I guess the biggest question would be, is it sort of like a checkerboard reality, or is it across the board blanket reality? So I started multifamily investing in St. Paul, Minnesota. St. Paul, Minnesota right now is kind of the leader in rent controls. And even my buddy, who is he's a syndicator with me, but he started out as a property manager. So he actually manages these properties in Minnesota. I called him up and I was like, "What does this mean?" He's like, "I don't know." In other words, the legislation or the ordinances passed so quickly that the attorneys that are advising the property managers are not clear about what the words mean. So we're seeing it in St. Paul. There was an article in the Wall Street Journal a couple of weeks ago. I posted it on my Instagram. There's a number of cities in Florida where they were seeing rent controls. There's always, I think, concerns about rent controls. I grew up in Chicagoland. So Chicagoland would be one, the urban areas of California, the Northeast. I think right now, it's going to be sort of a regional reality. We were having a sort of a Q1, risks to the business conversation with my partners. And we said a national rent control law would be like the biggest systemic risk to our business, right? Because our and basically every other investor's investment thesis is contingent on renovating properties and then getting a return on your capital for renovating properties. If you can't get a return on your capital,
why even deploy it?
What's that, Nelson?
Why even deploy it?
Right. Well, of course, the other option is spend almost nothing on expenses. So reduce your spending on repairs and maintenance and looking after your tenants or your landscaping or repairing that parking lot. Because if you can't make more money on the top end, reduce your expenses on the back end. There's only two levers to pull, right? So
Mhm.
that's why rent control tends to result in slummy places. And I'll just tell you emotionally, I don't want to run a portfolio of properties that I think are slummy. But I think that's a risk. I think the best you can do is be judicious in the political climates that you invest in. Yeah, that's my thought on that. It's a smart question, Nelson, because it's out there in a way that it hasn't been in the past.
And thank you. And I also wanted to ask you, so we've been talking about inflation, but now we've got actual land warfare, like you mentioned in Europe. What are the primary, secondary, tertiary impacts of that you see? And where are the opportunities? Because I mean, unfortunately, and I was one of those guys who deployed a bunch of times, okay? But where are the opportunities? And as a matter of fact, at one military course, we actually war gamed that, Ukraine, breakaway republic, Russia. I mean, we would war game this thing to the nth degree. So it's strange to see this now.
Yeah, Nelson, I honestly don't know. I mean, I don't know how this impacts our investing, right? Other than, I think the one thing that I think it brings us back to is the conservative nature of why we invest in multifamily, right? It's why I like this asset class, why over time, a higher percentage of my investable resources have gone into multifamily deals, right? There is no substitute. There is no creative destruction that's going to stop the need for people having roofs over their heads. And we saw in the last 2 years that the political class will support multifamily in a way they're not going to support sort of the competing verticals. Self-storage, for instance, won't get this rent assistance. So in uncertain times like this, I kind of feel comfortable having my money in bread and butter workforce housing that serves the needs of the large sort of middle of the bell curve of America. So as how will Ukraine specifically impact investing? I don't know. But if you have thoughts, I'd honestly love to hear them. I haven't been able to come to any concrete solutions to that question.
I mean, for me, ask the question, and thank you for your answer. I mean, I like short-term rentals. So I was going to ask you also, what are your thoughts with the inflation and short-term rentals?
I'm actually under contract to buy a short-term rental and close on in about 3 weeks. So I hope it's good. Yeah, I think the demand for short-term rentals has been huge in the last couple of years. I don't think it's going to go away. It's an amazing new industry that didn't exist a couple of years ago. I like places that basically they can't build any more of. So that could be, beachfront. I like it when it's near population centers. I like that area a lot, that sector a lot. It's subject to more regulatory risk. So I think it's higher returns and higher risk in short-term rentals. You've switched from collecting people's core spending in their non-discretionary apartment to having a beautiful home for $1,000 a night that is certainly a luxury spend, not a necessary spend. So I'm actually looking at a place in Hawaii, which the reason I'm doing that is because number one, I'm on the West Coast, but number two, Hawaii benefits from all of the wealth creation that's happening in China, right?
In Asia, yeah.
In Asia, right? Because it's kind of halfway across the ocean. So that's part of my thesis on that one. But I literally have a good friend of mine who was a medical doctor. And about 5 years ago, he started buying like 15 to 20 bedroom places in the Smokies. And he just quit his career as a medical doctor. And he's living off that right now. He's spending more time with his kids and they're volunteering and traveling, and his life sort of changed from those investments. So it's very, very cool to see. And that's a result of a very neat sector, the short-term rental sector.
Yeah.
So I'll never put to me, it feels more risky. So I might kind of I don't know, dabble is kind of a light word, but I'll play in that sandbox, but I won't sort of plant my flag there for me personally.
Okay. And I think we just got a question from Sonia Brown on that.
Yeah, I'm not syndicating it. I've thought of doing that before. I've talked about it, but right now, as far as the business goes, our business is focused on multifamily 100%. So this is just kind of like a thing for me.
And actually, so a question I got is a private message from the previous on the rent control side. Let's say, what do you think is the best way to market a rent control property for sale? I'm not sure if you had, personal experience with that.
Well, gosh, I mean, there's only 3 levers you can pull in this industry. There's 3 things that you can do I always say, you can't buy a property unless you can solve a problem, right? And so what's the problem that you can solve? Rents are too low, expenses are too high, or occupancy is too low. Those are the only 3 levers that I can think of to create value in this space. 95% of deals that I've seen, it's been rents are too low, right? Or maybe an occupancy play. But predominantly it's a collections game, not an expense management game. So let's just say that there was a magic wand waved and rent controls existed. You'd have to switch to buying properties where you think that you can basically reduce the expenses. That's how you do it. And I think that'd be pretty tough. You would see the value of properties impacted significantly because not a lot of them are going to qualify for that skill set, right? We just bought a property where 45 units are either vacant or down on day one. There's about 200 units in total. And so that's a vacancy repair issue, right? So you could create value in that as long as you got a discount for units being vacant. And that's tougher to do in a seller's market where some people will pay X dollars per unit, whether the units are full or empty. You'd have to have good pricing discipline to do that.
Yes, so that you made a great point, right? It's just so you could have the optics of a value add, but it's priced in or even overpriced. You didn't get a discount for that, then it kind of like.
That's right. And so, I mean, the sort of academic answer when you're buying a property is, hey, listen, if I'm going to create the value, I need to get the upside on that. I can't pay you, Mr. Seller, the value that I'm going to create by fixing the problems that you had.
Yep.
But that's tough nation when 18 other people might be willing to sort of pay them half of that value creation, right? So,
so question like from Andrew, actually, do you anticipate any changes in lenders' appetites for risk in this environment? If the economy takes a turn for the worse, does it pose a challenge to achieving those mid-teens returns for investors? Should lenders become more risk-averse?
Well, it's an interesting question. When COVID happened, the gap between the financing products that you could get as with bridge debt and with conventional debt or agency debt shrunk a lot. And so bridge money became a lot more attractive because the terms were so good. The proceeds were so good. And the reason that happened was so much money, wanted to find a safe home, right? And so a lot of sort of institutional money went into the lending space of multifamily and sort of it got squeezed out through bridge, right? So if the question is, how do I see it changing? Rates will go up moderately. I don't think severely, but rates will go up. And I think that we'll see a pullback in the attractiveness of bridge debt. I'll just tell you anecdotally. So when you buy bridge debt, you also need to basically buy an insurance policy. So if interest rates go up, your interest rate does not go up, right? And the cost for those policies have increased tremendously recently. So even when interest rates aren't going up super fast, the attractiveness of bridge debt is already, I think, receding.
So another question actually is from Chris. So how do you view a value add Class C opportunity in which, let's say, 10 out of the 100 units have been renovated and the model is proven? So this kind of deal. And so I'm seeing these types of deals pop up a lot now, where the owner bought within the last year or two, did a few renovations, and they're exiting with meat on the bone. So my personal though is they did a few improvements and sucked out a bunch of meat and now leave the next buyer with very little other than to complete the remaining units, which means there aren't many futures buyers to exit to.
Well, that's part of what I was just saying a minute ago, which is that if you're a disciplined buyer, you basically say, hey, listen, if I'm going to create value on the remaining 90 units by implementing the strategy of renovating units on time, on budget, and leasing them up, then I need to get compensated for that. And as a result, you wouldn't overpay for that property where only 10 units have been renovated, right? And really only a lot of time doing the math and modeling it out will tell you what that price is. But those properties are really basically very fun to model out because we call them self-comping, right? I can look at that property and know that the units are like once they're renovated, they're going to rent out for whatever the price is, $995. You don't have to look at the other properties that are nearby. So self-comping properties are the best ones to model. And I think they're easier to sell to your investors too, if you have an investor base, because you're not like, oh, well, that property did have a pool, or that property is closer to the highway. It's the same property. It's self-comping. So I like those a lot. You just got to make sure not to overpay for them.
Mm-hmm.
And I don't think having only 10 units out of 100 renovated is limited meat on the bone. If it was the inverse, it'd be true. If you'd already done 90 units and only 10 were left to renovate, that would be true. But I think that's a fairly good deal as long as you get it at a fair price.
Mm-hmm. Yeah, that makes sense. I mean, there could be situations where, let's say, you have just 20 units that you can actually improve, and then like half of them are improved already by the prior operator, and they happen to be the ones that are the easy ones to improve. And so they could be leaving you kind of with what is not so, let's say, rent increases that are hard to implement and so forth. But then it also puts a challenge in the event those are not implementable, then how much meat on the bone you leave for others and so forth. I think the question a little bit touches on that, but I think you answered it pretty well. And I agree with for the early, it's, I mean, 10 out of 100 would be pretty early at that stage. And so another question like from Sony actually, so what are your thoughts on build to rent? I've been seeing more of that coming up lately. So like Neil Bauer is doing build to rent in Idaho, I think, and other people and so forth. Mm-hmm.
Yeah, it's an amazing space. It kind of goes to what I was saying about that this area used to be sort of like a fringe area of investing, and it's gone mainstream, right? So you have to have a tremendous amount of institutional money going into build to own. I'm in here in Seattle, and my brother-in-law is a home builder. He must build, I don't know, 400 or 500 homes a year. He's got quite a machine, and he used to sell them one by one. A family with a picket fence and a dog. And now he literally will like develop 100 homes, get one check from a build to rent fund, and just be done. It's an amazing sea change in who owns real estate and how real estate gets done. And he's like, he said they have so much money to deploy that they don't ask for any discount for buying 100 homes with one check. They're like, here you go, 0, 0, 0, 0, 0, 0. He's like, I'd give a discount because they're so much easier to work with. There's a lot less drama, but they just write the check. So the question was, what are my thoughts on it? I mean, it's amazing. And by the way, that as an anecdote, he's moving to Idaho, so maybe he's going to work with Neil. I don't know.
So I'm sorry.
A lot. It's a further one more second, Nelson. It's kind of what I said before, that a higher percentage of Americans are renting, right? So in that anecdote I just said, it used to be people that were buying their homes to live in, and now the people that are going to reside in those homes are renters.
Do you think that's raising, do you think that's together with like some of the iBuying and so forth is contributing to like the spike in like single family house prices and so forth? Or you don't see build to rent as such a like appreciation kind of contributor to that?
I mean, if price is just the meeting of supply and demand, there's a lot more demand for housing when there's billions of dollars chasing build to rent. So yeah, I'm sure it has an impact on pricing.
Okay.
Nelson, you ask a question?
Yeah, I was gonna ask you on the build to rent. I mean, do you see that as a competitor? One, competing for tenants, two, competing for capital?
They're not competing for tenants. I mean, the tenant that rents a
Build to rent.
3-bedroom, 2-bath,
Uh-huh.
single family home with a driveway and a backyard is a different tenant than who's renting our apartment units,
Mm-hmm.
right? And honestly, like I remember I toured this factory here in Seattle, and they specialized in hiring, I think it was refugees or it was like ex-convicts or some of those kind of like had a difficult background. And we were talking to the CEO about employee retention. And the CEO just basically said, listen, my business model works on paying people $20 an hour. That's what I can do. If one of my employees is able to demonstrate that they have the skills to warrant a $30 an hour job, I'm so excited for them. And I'm like, go take that job, and, grab that next rung on the economic ladder. He was excited for them, right? And in the same way, if I have a tenant, because I get a report on why people don't renew their leases. When I see that someone, went and bought their own home, I'm like, that's great. I'm so happy for them. Like I can't knock that. I can't be discouraged by that. So I don't think that's really competing with us. I think that's like the next rung up, right? You go from an apartment to a house. That's a common trajectory.
Mm-hmm.
As far as investor capital, our investors are generally individuals who want an alternative to the conventional mutual fund model. So it's 100K investors one at a time, that kind of thing. That's not the kind of person that invests in a mutual fund. I'm sorry, a build to rent model. Those are like life insurance companies and state teachers' pensions, stuff like that. So I don't. On some level, it certainly is competition, Nelson, but it doesn't. No one's ever been like, I was going to invest in that one Nighthawk deal, but then I went to the build to rent, fund in Idaho, and that's the right one for me. I just never heard that. So there's a lot of things that I'm, worried about, but that's just not front and center for me.
That's not one of them.
No. So I'm sure it happens on some level, but you can only fight so many battles.
Okay, thank you.
Yeah.
So a question I got, kind of a private message from Bradley. Actually, what are your thoughts on mobile home park investments? I guess also in the current, let's say the current cycle. I know like some of the cap rates have compressed everywhere, but significantly in MHP compared to like a few years ago.
Yeah, I have friends in mobile home parks. I haven't done it myself. I can't knock it. I think it makes a lot of sense. Whether the pricing has been bid up to where returns are less attractive, I can't really opine on. But it's a great defensive industry, right? Like it's really hard to bring on more supply for those. There's a lot of Americans on fixed income for whom that is, the least expensive housing. They're not transient because they often own the homes and they just rent the lot from you. So there's a lot of neat things about that area. My sense is a lot of capital has gone into it and sort of bid up the prices to the point where it's not what it used to be. One of my friends who's in that space said he was lured into it by the idea that it would be much more passive because you only own the land. And he's like, it's not true. He said the work that you do to bring in new units and zone the lots is a lot of work. So I think in that sense, there's a little bit of fool's gold in it, but I think it's a cool area. I mean, I'm bullish on it at a high level.
So, so what do you think about? I mean, I'm just looking at Bloomberg actually right now. For the 2-year and 10-year Treasury yields, let's say, and so let's say it's looks like some of the inversion looks like got corrected actually as of today, but it was like 8 basis points before on Friday. So what do you think about that? Are you concerned, or you?
I mean,
or you don't think that's going to have an impact on real estate? Let's say.
I guess I have a couple thoughts. The yield curve is inverted because while short-term rates are going up, the bond market thinks that in the long term inflation will be under control, right? That's why
yes,
the 30-year, the 10-year is at a lower rate than the 2-year. right? So that's one reason why I don't think we're gonna have inflation forever. There was an article in the Wall Street Journal about it, I think over the weekend. I think Greg Ip wrote it. That was just fantastic. So much good data, so much good analysis. And the correlation between fully inverted yield curves and recessions within the next 12 to 24 months was almost 1-to-1, right? It was amazing.
Yeah. That is kind of the point being there, right? Exactly. Yeah. And there's only 98 that it didn't happen. It actually even happened for the COVID quote unquote recession. It wasn't even a very short-lived recession, which is quite impressive. The 2019 inversion predicted that. Because how do you predict a pandemic caused recession, right? I mean, it's quite interesting.
Yeah, I think so. I mean, I think in a narrow analysis, that's why you like to have all your options available to you, that your debt won't preclude you from taking certain actions, maybe selling an asset if the market is good. In the long term, though, I mean, I try to think about owning multifamily in like a decade plus horizon. If you think about holding real estate for 10 years plus, I guarantee you're gonna have a recession. We always have recessions, and we always come out of them strong. There's another great graph that I just posted on Instagram, and it was reasons to sell your stock portfolio. And it just mentioned, here, I'll put my handle here so you can see it. It just mentioned all of the calamities. Sorry, here, one second. There you go. All of the calamities that happened in the stock market in the last 12 years. COVID, Ukraine, avian flu. I don't know. Stock market goes down by 600 points, and it was a never-ending chart up and to the right with little deviations, and all those deviations seemed so material, and they got so much ink in the week or the month that it happened, and it kind of washed out to nothing in the long term. And so that's equities, right? Not real estate. But my basic point is fear sells, and I think we'll probably have a recession, I don't know, in the next 2 years. But it doesn't question my thesis that multifamily is a fantastic place to put your resources for the long term. And I think that we're all long-term thinkers. That's kind of my thoughts on it.
Agreed, but more like to the question of like changing underwriting and so forth. Let's say, like, do you look at perhaps that's why some of the more flexible exit strategies, right? Is that one of the reasons, like one of the because in a way, like, you want to be flexible if you wanted to exit in 2 or 3 years and so forth. So
that's right. Right. We certainly have some deals where the exit strategy, the penalty for leaving, is driving a hold, and without it, we would have sold. Right. And I don't ever want to be in that position again, honestly.
Because I agree with the fundamental premise that you have. I think that's strong. It's just more like, how do you change your investment strategy in the event we are towards the end of a market cycle, which we don't know if it's even the case, because then there's the question of, so yield curve super highly correlates with recession, but then recession doesn't so highly correlate with the real estate downturn. It's not always. It hasn't always been the case, actually. So, but
we always say that our what we do is quite recession resistant, and I believe that that's true, right? I think you want to have your options available to you. Let's say you had 3 deals and you thought, we're probably gonna have a recession. The yield curve's inverted. That might be a good reason to sell one of them, take chips off the table, stay liquid, and then buy again if and when asset prices, have a little step back.
I actually on the yield curve, something that I found actually interesting, if I might add, because you mentioned the almost 1-to-1 relationship within, I think the 1-to-1 is up to 24 months, right, Drew? I think that's kind of what they had.
Yep.
I think up to 24 months becomes 1-to-1, and if it's within 12 months, it's 2/3, 67% or something like that likelihood. And but the other thing that I found interesting there is about the stock market, actually. So that they had that, so how much time before the beginning of a recession, the stock market actually peaked, and that range was 2 to 12 months. But then the current peak was 3 months ago. It's actually been a while, at for S&P 500, close to And we're running out of time. So it's actually, in the event the current peak does not get exceeded, it might be 9 months to the next recession or something like this. It's kind of, it just like kind of play on like historical things. Of course, it's not a, you never know what's going to happen this time. But if one takes like this kind of stock market view, then okay, maybe it's like 9 months left, unless we exceed the current peak there. Or otherwise we would have like a more different scenario now that it's like different from the history, and that's completely possible. And that, but I found it interesting indeed, like it's quite predictive. And like I said, for me, it was even more interesting that 2019 predicted the COVID quote unquote recession. It's not even a recession, right? That's pretty strange.
That's crazy.
How does that happen? Right? I mean, that's pretty interesting. And so yeah, we had some some good questions here today. So Drew, what is the best way for people to reach to you?
Yeah, thanks so much for listening. If you guys want to sort of join what we're doing at all, it's I got the links at the top of the chat, but it's nighthawkequity.com/join. And we also have our yearly event where everyone goes down to Dallas and we just talk about this stuff for 3 days straight. It's a really fun time to talk multifamily. We have economists coming to speak. We have deal makers. Neil's been there before, Neil Bawa. So that's the top two. That's dealmakerliveevent.com. And would love to, have you guys join our next webinar or next deal, or meet you in Dallas and kind of talk about this stuff in person. It's a great space to be in, and I love talking to everyone about it.
Okay, so nighthawkequity.com/join, to join your investor list. And with regards to the Deal Maker Live, so when is it happening?
It's June 2 through 4 down in Dallas.
Okay.
We're going to have, 800 to 1,000 people there. It's going to be a huge event, and great speakers, great networking, and just a place to like charge your batteries. It's really fun.
Okay, so that was great. I think it was great timing to have you here today, Drew, and that's a really good input. And I'm glad to see like some of the changes you guys are doing with regards to underwriting. It's like I'm curious. I was curious for that myself. So with that, like, thanks to everyone for joining us here today. And thanks, Drew, as well. Have a good night.
Yeah, you bet. Thanks so much.